significant decline in the markets. Do you feel that what's coming up on Thursday could possibly trigger that? You're saying they're using outdated policy.
I do. Yeah, I do. I most definitely do. I think this is, it's not just me. Several of the city economists here have put out client notes saying that this is a replay of October 87.
And you feel it'll be reserved fairly quickly or reversed? You feel that the interest rate will come in as a raise and then they're going to have to recant and come back down in a matter of weeks?
I don't want to make any predictions. I just see a risk here that they have not understood the fragility of the global credit system at this point. We've seen all the stress indicators flashing warning signs again, overnight LIBOR and what we call the ITRAX crossover index here in Europe, which is the default risk on high-yield bonds and so forth, is rocketed up to about 550 again today. There's real concern out there in the credit markets, and credit tends to precede the stock markets.
Is that why U.S. Secretary of the Treasury Hank Paulson is preparing to get on a plane and go over and talk to the bankers?
Yeah, well, he's coming over to Europe anyway. In fact, I think he's here already. He's seeing Trichet and head of the European Central Bank and Webers, head of the Bundesbank, and I think he's going to be telling them that they need to move with extreme care on Thursday. I don't think he can talk them out of a rate rise at this point because the ECB's credibility is now committed to a rate rise, but I think he's going to tell them that they need to signal that this is one and done, and there isn't going to be a series of rate rises, and that they're on a neutral stance after that. That's what he's going to be telling them, and I think he'll be conveying to them the extreme irritation of the U.S. government over effectively the way that the ECB is kicking them in the teeth.
Let's lay out, perhaps, for our listeners, let's just lay out the two camps that are sort of battling each other out. We keep on talking about the stance that the European Central Bank is taking and the fact that harkens back to sort of the German influence, really, the Bundesbank influence from the 80s, 90s, and if you wanted to go back even further than that, you could, where they have an extreme sensitivity to inflation. More sensitivity than perhaps other central banks, certainly the U.S. Central Bank. So on the one hand, you've got the European Central Bank focused or even fixated on inflation. Now, their camp is supported by the BIS there in Switzerland, who is saying that, yes, in fact, there is an inflation problem.
Well, that's not how I read their report.
Okay.
I think they're concerned about global inflation, that global interest rates are too low. That's undoubtedly true, and the chief reason for that is the 45 countries are linked to the U.S. dollar. They've imported the U.S. Federal Reserve's policy into their own countries in circumstances for which is that not appropriate at all because they're overheating. Now that they have dollar pegs, and that's their problem. Should China be shadowing the dollar? Of course not. They have imported an inflationary policy into China because they have been essentially massively buying U.S. bonds, buying the dollar to maintain their trade advantages, if you like.
Correct.
What they should have done a long time ago is just let the yuan gradually appreciate, and they would have not have built up such a huge trade surplus. They wouldn't have gained in the short term such a large advantage, but they would have had a much more stable economy as a result. And now, of course, they're paying the price because instead of getting it on the chin from a revaluation of the yuan, they're getting it on the chin from internal inflation, which is really very high, and especially on the seaboard in eastern China, is getting up to about 25% probably. So they're losing competitiveness very fast anyway. You've got countries around the world for different reasons that have tied their fate to the dollar at a time when the U.S. was slashing rates, and so they've slashed rates. They've effectively imported that policy, if you like. Mm-hmm. And that's their lookout. And that's really what I think the BIS is focusing on them. It's saying, the rest of the world, roughly half the world that's inflating, if you like, needs to get a grip. But there's a totally different story for the OECD, for the mature, richer countries, which is basically Japan, Europe, and North America. I don't think they do have a serious escalating inflation problem. I mean, this is the great debate. Is this a return to the 1970s? Is this the beginning of a wage price spiral? Or is this a one-off spike? Well, if I'm in the camp that thinks it's more of a one-off spike and the actual core inflation levels are relatively stable and real wages are not picking up, in fact, they're being squeezed. So this is just a transfer of wealth from the Western countries to the commodity countries.
Well, and so again, there's the key difference is you've got the European Central Bank focusing on headline inflation, which includes food and fuel, whereas you're saying that core is relatively tame. And at least official statistics here in the United States do show core inflation is relatively tame. So it kind of is boiling down to what statistics are we using as our starting point?
I mean, you're exactly right. They're looking more at the kind of headline. They're also looking at credit growth, and credit growth has been reasonably robust in Europe. But the BIS has warned about that, as have a lot of city bankers, that they may be misreading the data. I mean, one of the reasons credit's growing is because the securitization market has collapsed in Europe. It's shut down. There've been no new junk bond issues at all. You can't raise money in bonds unless you're a very, very blue chip company, basically. So they're all having to draw down their pre-existing credit lines from banks. It's a sign of distress. Now, you can interpret that as a strong rebound in credit if you like, and the BIS has clearly warned them that they don't interpret it in that fashion. And secondly, a lot of these banks have had to take their portfolios back onto their balance sheets from all these off-balance sheet SIVs, and that surfaced as an increase in the lending figures as well. I think, the signs are that there's an incipient credit crunch developing in Europe, and it's going to get quite severe quite soon. So I think, there are quite a few people, and including people within the European institutions, I might add. I mean, this is a view. They argue among themselves about this, that thinks that they're being far too tight.
So then that second camp then, if you've got the European Central Bank fixated on inflation and headline numbers, the second camp is really focused on the fragility within the credit system, and that's Paulson.
On your point you're making about the historical issue with Germany, I mean, you're absolutely correct that the thing about the ECB, I mean, they obviously they inherited their mantle of credibility from the Bundesbank. And there was an implicit contract in the way, Germany was giving up its currency and everybody else was getting a part of it. And the contract was there should never be inflation in Germany, and the ECB should be as rock solid as the old Bundesbank was. And so they're having to almost sort of prove themselves, beyond what's reasonable to show that they're worthy of this inheritance. The problem is that it is true right now that Germany is beginning to inflate because Germany's gained massive cost competitiveness internally within the system. It's conquering market share in Spain and Italy and France. It is facing the risk of some kind of internal overheating. But the problem is the Eurozone is not Germany. It's 15 countries.
Right.
This is where the difficulty lies. Okay, if you stick to that you cannot have internal inflation in Germany because that's the contract, that's the implicit political contract behind this whole thing. If you stick to that means driving, a whole lot of other countries into the dust. This is an intolerable political situation. And I might add that, okay, there's this mystique about the Bundesbank. They had their great inflation in Germany in 1923, in which the bondholders were wiped out. And then they had a second great inflation in 1948, when owners of financial instruments lost 90% of their investments. So you had two great traumatic events, just about in living memory, in which the bond markets were destroyed. So this is in their minds. But I mean, one can exaggerate this, I think. I mean, I didn't really buy into this line that Germany's, culturally that much different from the United States in this respect. I mean, I don't think anybody likes inflation all that much.
Just a reminder, you're listening to the McAlvany Weekly Commentary at McAlvany.com, McAlvany. Don and David McAlvany just finished with this year's video called When Greed Turns to Fear, which is an in-depth analysis of the current situation economically and politically. You can call us at 800-525-9556 to reserve your free DVD. It should be out in the next several weeks. In the meantime, you can actually see the complete presentation on your computer right now. Just go to youtube.com. Many of you know what that is. It's youtube.com. And type in the search bar, Don McAlvany, spelled D-O-N space McAlvany. You'll get to see the whole presentation in 10-minute segments on your computer right now until we can send you the DVD. So call us at 800-525-9556, and in the meantime, check it out on YouTube.